Hi, class. This is the first of our guest spots. Pete, would you like to introduce yourself?
Sure. I'm Pete Vorbrich. I'm the Chief Financial Officer of Carval Investors. Carval is an alternative fund management subsidiary of Cargill. We invest in all kinds of esoteric things, among them real estate, both in the US and internationally. And over the course of my career, I had the opportunity to spend 5 years living in Tokyo, investing in real estate there.
So Pete, I used to work at Cargill, as you know. It's a place that, in many ways, takes advantage of other people's mistakes in real estate. Can you talk a little bit about that?
Yeah, the business we're in is largely based on dealing with problems that other people have created for themselves or markets have created. Essentially, things didn't go as people anticipated, project got kind of sideways somehow, and the people who did the initial investment just need to get out. And so that's an approach we've taken in real estate investing and in other kinds of investments over the years.
So are you telling me that even some very large real estate developers sometimes get it wrong, or are you just talking about the smaller scale startups?
No, it's some of the biggest ones can be the most spectacularly wrong. And I think it's important to note that any kind of business venture, whether it's real estate or a startup or anything, is based on a set of assumptions. You think the world is going to unfold a particular way and that you'll be able to capitalize on that. And sometimes you're wrong. And sometimes that's obvious in retrospect, but sometimes it's just bad luck.
So we're spending a little bit of time about the initial stages of real estate development, how to get it right in terms of due diligence and also the concept development right. Those are two things that I would think you could look at very much up front and prevent a lot of problems. Do you think that's the case?
I think you can to a certain extent. Now, there's things that can happen in the market that nobody would anticipate. The events of 2007, 2008 caught everybody off guard. But a lot of it you can. And there's a cautionary tale that I would tell about development as an industry, and that's a tendency to be a bit over-optimistic.
Right.
Over-optimistic about how much things are going to cost, how quickly you can get them done, how valuable your project is going to be at the end. And if you aren't sober-minded in designing and analyzing the project, you're just at risk of kind of getting deal fever and getting swept up in what can go right. And it can, and in many cases it does, but it also can be more difficult than that.
So we talked a little bit in our first lecture about Donald Trump, who seems to be everywhere in the news these days for other reasons. But as we know, he was a very famous and is still a very famous developer. At points in time, he's gotten it wrong as well. So somebody like that, who's eternally optimistic about the ways to change things and make things work, are they the type of people that typically get into trouble?
Well, I can't speak specifically about Donald Trump and his projects, but I would say that optimism, I think, is essential to business success. If you're pessimistic, you can always talk yourself out of doing anything. Oh, this could go wrong, that could go wrong. But you just need to temper it with an analysis of what you think can go wrong. And I guess what I would say is when you come up with your assumptions, you need to stress them and test them and say, well, if I think I can get this done in a year, what happens if it takes 2? If I think it's going to cost $5 million, what happens if it costs $6? You know, find the point where your model breaks down. Right. And how close is that to what you think can go right? Because if all those things have to go right for you to come out alive, that's scary. Yeah. If it can go wrong in a couple of ways and you still kind of are okay, then it feels like a chance, you know, you're smarter in making. Right.
So one of the things we've been doing, class will know this, is we've been looking at pro forma analysis. Mm-hmm. And so pro forma analysis, as you well know, is a way to project out what's likely to happen when you're developing a real estate project or buying a real estate project and redeveloping it. Is that where you do this kind of testing and trying to figure out if it went a year longer or if the additional costs were in? Is that where you look to do that type of work?
Yeah, that's a big part of it. It's always amusing when somebody comes forward with a pro forma with their projected rate of return calculated to 3 decimal places. Because one thing we know for sure is what you assume is going to happen isn't actually going to happen. Something like it might happen, better, worse, in different places. And that's really where you need to look at costs, timing, ultimate rent or sale proceeds or whatever the key variables are around that.
So sometimes they can go wrong because of the market. You mentioned earlier 2008 and kind of what went wrong there. So that even if you're very cautious about predicting out, there's still things that can happen externally in the market. It can have a big impact on your deal. Is that right?
That's right. In a number of areas, it can affect the timing, it can affect your costs, it can affect your ability to finance a project.
Right.
I mean, one of the big things from 2008 is that the whole financial industry was in distress, and so institutions, banks, had to be cautious. So if you had engaged in a project, say you developed something, and you assumed that at completion you were going to be able to refinance your development loan into a more permanent loan, well, suddenly 2008, 2009 comes around and the bank just isn't there. Or they're not there on the terms that you thought. And so you can't get the kind of proceeds that you thought. And so suddenly you need a bunch more cash than you anticipated needing. That's the kind of thing that it's difficult to predict what that looks like. We tend to think markets are orderly. They're always the way they are today. If that kind of financing is available today, it will be there in 2 years. It's probably right most of the time.
Yeah. So the past is usually a good predictor of the future, but not always. There's things that happen.
That's right.
Yeah. Can I take you back a number of years? I know you started your career as a real estate lawyer. Can you do? And we're doing this module that we're doing right now. We're called Money in the Law. So we've talked a little bit about financing. Can you tell us about the legal side of this? How does a real estate lawyer play in trying to control these risks? What's their role? What kind of documents do they use that are important?
Sure. I think most people's initial interaction with the real estate market would be a residential purchase. And those contracts are really prescribed. And so you sign this purchase agreement, you have this kind of a mortgage, and there really isn't negotiation to do other than what's the price I'm going to pay, and does the washer and dryer and the chandelier come with the house?
Yeah.
But in a commercial project, you usually start with a memorandum of understanding, which is just an outline of a deal. It's usually non-binding, but it's just a way of making sure that the buyer and the seller are on the same page about price and timing and key terms.
And that would be buying a piece of land or buying a building that you wanted to then go ahead and redevelop. Either of those cases.
Or you could have a MOU for a joint venture about how together we are going to develop something and split up the proceeds.
So like a joint venture equity partner, if you will. Okay.
And that's usually the precursor to the project. And once we've agreed on that, sometimes I put a deposit down, earnest money. It's usually refundable at that stage. And then there's an extended period for due diligence on the project, during which you negotiate purchase and sale contract. You try to line up your financing. If it's a project that's dependent on large tenants, like an office building, you're likely trying to find your anchor tenant for
beforehand, before it's even developed.
In some cases. So it's about who owns that risk. If the seller wants to get maximum proceeds, maybe they'll let the buyer spend the time to get all those things lined up. If the seller just wants out, they'll say, look, I want to sell it as is, where is, and you take all the risk, and then that gets reflected in the price. But those kinds of financing and purchase and sale and diligence, that's when you do your environmental analysis of the project to find out, is there anything toxic that's happened there in the past? If so, can it be cleaned up? Has it been cleaned up? Kind of property zoning, can I build what I think I can build?
Exactly.
Do I need to get special permission to do that? How hard is that?
You don't want to be surprised later, do you?
Yeah.
By something like that.
Will the seller let me spend the time to get the zoning variance that I need before I commit to the project? Or not? If they want me to take that risk, is that a risk I'm prepared to take?
And how about on new buildings? You've got things like architects. I mean, developers hire architects to do things, but architects often have their own opinions about what they'd like to develop. So there's a give and take there about what you're getting as well, isn't there?
There certainly is. And I think that's where you see lots of contingencies built into people's modeling assumptions about costs. Because at that stage, if you're buying it and you think you're going to build something and you've identified an architectural firm, but you don't have plans drawn up yet, you don't have firm bids on the construction. So there's a lot of wiggle room for what that's actually going to cost you to get done. And so that's where there's a lot of risk that developers bear in those kinds of projects. Is that I did buy it, now I learn, can I actually build exactly what I wanted to build? And now I learn, is that going to cost what I thought it was going to cost or a little bit more? Can I get it done on time? How long is it going to take me to get permissions, approvals, everything lined up to do that?
So it sounds like there's a lot of learning for a real estate developer in going through transactions, because you don't necessarily know everything up front. You're finding out things as you go, and you seem to learn from lessons and mistakes and things you might not have paid attention to in prior deals.
That's right. And I think that's why people who go into development tend to work with experienced developers as a way of learning the ropes.
Right.
It's important that you get the right kind of advisors, counsel, and others who have done this before, because a seasoned real estate lawyer will have a checklist and a whole laundry list of items that they'll know you should be thinking about, even if you don't know you should be thinking about it. And so that's where their counsel can be beneficial. And
real estate lawyers therefore become a real trusted partner in these negotiations with the real estate developer.
That's right.
Yeah.
That's right. I mean, I think your ultimate objective is if you're going to embark on the project, you want to go into it with your eyes open.
Right.
And you want to have identified as many of the risks as you can and buttoned up as many of them as you can. If you can get plans in place before you have to commit to a project, all the better, because now your scope of error has narrowed.
Right. So it's a lot about risk, timing, knowledge, experience, et cetera.
The other thing to remember is that the risks and assumptions that you make are codependent. So the tendency is, and sometimes we'll see some sensitivity analysis that says, well, rents are rising, and so if I run my model and I delay completion by a year, we actually do better because rents have gone up.
Right.
The world doesn't work that way.
It doesn't stay static, does it?
Yeah, if your project gets messed up, almost invariably other things are going wrong too.
Right.
And so then it's taking longer and renting at a lower rent. And so understanding how those assumptions impact each other is an important thing.
Right. So what do you think are the prospects for the real estate market these days? Are things coming back from the low days of the post-recession period?
I think yes. I mean, certainly the market for completed projects is very strong.
Yeah.
Interest rates are low.
Yeah.
Investors want income yield from anything.
Yeah.
The development market is still a little slower to develop because the financing market hasn't fully come back in the way that it had before. Banks are still feeling the scars
feeling the pain
from the last cycle, and so that has to kind of go through. But certainly a well-located project that has sound projections, is something that financing is available for now.
Great. Well, good to hear that. I hope this was valuable class to provide some actually meat on the bones of some of the things we've been talking about in class. Thanks again, Pete. Really appreciate it.
You're welcome.